perspective on the markets and especially these consumer tech stocks, why they've been leading, and is this the time to really look at them more favorably as we see some green shoots, a bit of positiveness in those particular counters? Let's get that perspective from Ajay Bagga. He's chairman of Elements Platforms, a market expert, and also we have Aditya Shah, the chief investment officer at JST Investments, joining us on India Tonight. Great to have you with us this evening, gentlemen. Ajay, while we've seen this overall bullish trend in the markets, some of these new age stocks that listed last year and this year, they've lost more than half their market cap. But what's your reading of the kind of fall we've seen in stocks like Nykaa, like Delivery, like Fino Payments Bank, and of course Zomato? Is it about unreal valuations at their IPO time? In fact, what do you put it down to? Because globally too, tech shares have been beaten down, haven't they?
Yeah, absolutely. You gave the answer in the last statement, Vikram, because the big fundamental changes, interest rates have risen. Interest rates have gone up, so the discount rate for the valuations has gone up, and the valuations have come down. Second, the tightening of the financial conditions, which is leading to lower valuations. These are the two big changes that have happened. Future cash flows are getting a lower discounting for today's value. That's what's happening. Should you touch these stocks? I don't think so. This is the time to stick with quality, stick with a very clear cash flow, which is evident on the ground, not on hopes and stories. The time of hopes and stories will come again, but that train has left the station already. And if you get in now at these valuations, even, it might take you multiple years to really make up a good return on your investment. I would say the time now is to look at real cash flows and real profit generators rather than the hope stories.
Stories right now we don't need to look at. Aditya, do you agree with that point of view that Ajay is bringing to the table? I want to understand from you why you see this aversion to tech stocks, especially with these startups that we're talking about, the ones that have been listed recently. And it does seem like a global phenomenon. So if you can put that in context, how you see it.
Definitely. Good evening. I agree with Bagga sir that the valuations at which these companies got listed were extremely aggressive. They were listed saying that you cannot use traditional methodology to value tech stocks. Now, as liquidities continue to dry up, profitability on none of these tech startups is great, and that is why the stocks are really correcting. So, as I said, one or two companies are still good. For example, Nykaa is a very good company. However, the valuations still continue to remain extremely aggressive even after the 50% fall from the top we have seen. You can look at companies like Nykaa, keep them on your radar for any correction that there may be. However, for companies like Zomato, which have no idea on how they will turn to profitability, it will be very difficult task. There is a difference between the correction that is happening in the Nasdaq and there is the correction that is happening in India. The difference being that all the Nasdaq companies are profitable and cash-rich companies. On the other hand, all the Indian tech startups are not profitable as such. So, in my opinion, stay away from companies where cash flows are not great, profitability, visibility is completely not there. And as Bagga sir really said, you have to now start to bet on very high quality companies backed by good, rich cash flows.
So then, where is the traction going to come from if this bull rally that we've seen in recent times, Ajay, despite the reservations you've had, do you see that continuing, and where is that momentum going to continue, or where is the expansive action going to come in for the markets?
I would just step back, Vikram, a bit and say, historically, what happens is first the currency volatility goes up, then it contaminates the bond market, and then the equity market follows. What we have really seen globally this time around, the currency, of course, the DXY dollar index went from 92 all the way up to 105, 106, where we thought the peak of the cycle is nearing, and then it surprised on the upward move again to 118. It's probably going to 180. The currency volatility is on decade highs. The bond market volatility has reached decade high, but the equity market volatility didn't move. You have VIX for the US markets at such low levels. It normally doesn't happen when you have corrections of 33% on Nasdaq or 25% on the S&P 500. So equity markets have been complacent. Right now, the momentum is on a FOMO rally of fear of missing out because there is enough stimulus remnant money in certain pockets which is chasing the stocks. This is not the market bottom yet. June was not the market bottom. Right now, we have not made this cycle's bottom, but seasonality is in favor of stocks. Normally, these 3 months are the best months for equity market performance. The 1 year after the US midterm elections normally gives 12 to 14% returns for the US markets. That's the best of the 4 year presidential cycle on average that you see. And third, given our thesis of a US recession sometime in second half of next year, the market will probably peak, 3 4 months before that, around May or June. So I would say probably you are set for a market bottom sometime in Jan Feb. That's what kind of makes sense to us. Right now, it's a momentum rally. Use that to lighten positions. This is not the time to buy into this market. It's not based on fundamentals. The three-way process which I explained to you, currency to bond to equity, is still playing out. The equity volatility is not justifying a bottom.
Sure.
The second big part is first the shoe falls off in terms of
Yes.
valuations, then earnings go down, and then capitulation comes in. So
Right.
right now we are just entering the earnings phase. Capitulation has to come in. That has not come in yet, Vikram.
Fair enough. Aditya, how have you digested the kind of earnings reports that have been turned in across the sectors, the kind of companies that you've been looking at? Because the markets have seen this 4% rise in October. We are seeing the earnings reports come in. How do you see the month of November actually panning out for the equity markets from this point onwards? Because November could be naughty, it could be nice for investors. And of course, notwithstanding the Fed's action on interest rates, which of course is going to be the big determinant, isn't it?
The result season up till now has been okay. The banks have pushed credit growth into the system. That's the only big takeaway that I can take from here. Now we will see all the weak results coming out for the FMCG sector. We have seen all big FMCG companies reported degrowth in volume as prices have gone up. Now again, the pharma companies have also disappointed, barring Sun Pharma, which has posted somewhat stronger results this quarter. So I believe that volatility will continue to remain all through November, December as well. There is no question about it. The market needs answers from the US Fed as to when this interest rate hike cycle will start to end and when the Fed will start to pivot. It's a very difficult question to ask, and we need to look at the pointers in the November meeting as well as the December meeting. So all in all, the only thing guaranteed in the equity markets right now is equities will be very, very volatile. You have to go and bet in very high class quality companies which are backed with strong promoters, so that even if there is a 15, 20, 30% correction, the stocks tend to recover over a longer period. So in my view, be ready for volatility, but don't shy away from the volatility. The volatility is an opportunity to build positions in some very high volatility.
Fair enough. So, Ajay, clearly from what you're saying and what Aditya is also seconding, the worst is clearly not over for the markets. Like some analysts have said, that inflation could have peaked, that FIIs have taken out, or that they would until this point in time. So this is perhaps not the time to go long. So you would still stay wary. Which are the cues that will tell you that you need to kind of look at these pockets more favorably, perhaps to stay defensive and stay risk on?
If you look at the change in positioning, Vikram, in June, the markets went up on the thought that there will be a rate cut sometime by early 2023. Then by August, the market commentary changed to, oh, they will start doing a pause. Now it has changed to, so from cut, it came to pause. Now a pivot is being described as, instead of 75, in December they do 50, in February they do 50, and then May goes down to 25. That has become a pivot for this market. See how the positioning is changing. Nothing has changed on the ground. The Fed has not called it a pivot at all. Fed is again going to say tomorrow we are going to stay higher for longer. So I totally agree with Aditya that this is not the time. You might buy quality on a 10-year basis, 5-year basis. I'm extremely optimistic on India. I'm just saying the next 3 to 4 months, I am extremely cautious right now. We have to see one wheel coming off in the global markets. That's where will be a good entry point. We won't be able to time it, but on a broad sense, keep that in mind and keep some powder ready. That will be the time to allocate in 20-25%. For now, I think it's better to hold on. Maybe I'm wrong. Nobody can time the markets, but this is my historical patterns. That's what's telling me. This is how markets behave. Will it be different this time? I don't think so. It will look sometime that it's different, but then it will just flatter to deceive. So you're getting bear market rallies in the US, which is taking up global market sentiment, and you're seeing a lot of FOMO coming in. It will not be very durable. That's my fear.
Well, that's the fear. FOMO is sometimes, a pitfall that sometimes we have to deal with. And at this point in time, as we see this kind of bull trend continue, and it has been for a while, we perhaps might get into that kind of space, that mindset. But both our experts tonight agree that this is not the time to really do anything that isn't something that takes you off that risk on mode that we've been in, like many other experts have been pointing out to us as well. It's always a pleasure talking to you both. Thank you very much for joining us with your perspective on the subject about the markets and some of these tech stocks that have been listed in recent times. So the case for the business outlook might be changing in for the positive. It really isn't the time, our experts say. Meanwhile,